Thank you. Thanks for the introduction. And then I'll just jump right into it, given the time constraint. I hope the screen is visible, right? Okay.
Yeah, it is. Yeah, it is.
Awesome. So this is my background. I think, the host has done a great job of introducing me. So I'm not going to spend time on the background. This is the product I used to manage. I launched the product in November of 2018 at my previous organization. The product did phenomenally well. And, we were very, very fortunate to be a part of that journey. In September of 2020, I left DSP Mutual Fund to join InCred, PMS. And the job here at InCred is to manage the InCred Healthcare Fund. So let's talk about the InCred Healthcare Fund. And let's first talk about the healthcare sector. How do we look at that? And then let's talk about the fund as to, what the fund represents as an opportunity, both for distributors and for potential clients out in the audience today. So how do we look at the healthcare sector? We broadly divide the healthcare sector into 5 buckets. So one thing I want to message very, very clearly in this presentation, as I speak, you'll realize healthcare within itself is a very, very broad bucket for investing. So even though a healthcare fund may be a thematic fund in the sense that the underlying consumption theme is healthcare, but each of the business models within healthcare are extremely diversified and non-correlated. And therefore, the product itself is actually a diversified product. And there is more than enough data out there which substantiates what I say, but to the paucity of time, I'm not going to take you through the data, but the conclusions of the data. Okay, so the first bucket in the healthcare sector is the unbranded generic bucket. Now, in unbranded generics, essentially, these are pharma companies in India which sell generic products to export markets of US and Western Europe. Now, the US and Western European markets, by and large, have a regulatory framework where if you're selling a generic, you're not allowed to brand the product. So that means you will be selling paracetamol by the name of paracetamol or ranitidine by the name of ranitidine. You cannot call it Rantac or Crocin or whatever you wanted to call it. Because of which what happens in the end markets place, when the patient goes to the pharmacy to buy ranitidine or paracetamol, he says, give me ranitidine, give me paracetamol. The pharmacist has to tell him that he has 7, 8 different paracetamols or ranitidine, and which one would the patient buy? And the patient more often than not will buy the lowest priced paracetamol or the lowest priced ranitidine. So therefore, as a company which is selling these products to these markets where it's completely commoditized, there is no differentiation between company A and company B's product. And therefore, what sells the product is the price. So as you can imagine, it is a commodity business model where it's a push business. So you have to push your product to the wholesaler, push your product to the retailer, push your product to the consumer. And you have to make margins that are left over after the pricing competition between you and your closest competitors. So it's a very difficult to do business. The business has been under intense pricing pressure over the past 7 to 8 years. Regulatory issues, US FDA issues in the sector are very common. We keep hearing about US FDA problems with many, many different entities. And then the return on equity on this business is very, very low. Simply because in this business, pharma companies act as manufacturers, and you have to keep your costs low because you have to keep your price low. You have to keep your costs low. So you're vertically integrated. You have a lot of, supply chain management and all that, so which creates a very asset intensive environment. And therefore the ROE is just not good enough because you're keeping low pricing, making low margins, and your asset base is very high. So the ROE is generally very, very suppressed. And it has been the case over the past 7 to 8 years. But this is the bucket, which is the largest bucket within healthcare. It is like 45-50% weight in the BSE Healthcare Index, which is a healthcare index. So what we like about the unbranded generic space is that there are certain stocks in the space which have actually come to valuations from where we see absolutely no downside. We just see upside. I mean, these stocks can be potential multi-baggers in 2 to 4 years if conditions were to improve for this segment. But then there are other stocks within this in this bucket where the business is already doing okay, average, and therefore those stocks don't really give you a very good opportunity to invest. So we have only 2 names in the bucket, and that's about 10% of our portfolio allocation. The allocation in the index is about 45%. So we are way away from the index in this bucket, way underweight. The branded generic bucket. So in this business, basically, is the branded business that we see in India. So pharma companies sell brands. They sell Crocin, they sell Calpol, they sell Rantac. So here, when the patient goes to the pharmacy, he doesn't say, give me paracetamol. He says, give me Crocin. Now, if you look at all of your own individual behaviors, none of us would have ever asked the pharmacist, what is the price of Crocin, right? We just go and say, give me Crocin, and how much do I have to pay, right? So this is a pull business. Here, the brand of the product makes the patient and the doctor pull the brand off the shelf, and therefore the bargaining power in the supply chain lies in the hand of the owner of the brand, which is the pharma company. So in this business, the majority of the pharma companies actually behave like FMCG companies. A lot of the products that they sell in the market, they actually don't even manufacture. I'll repeat, a lot of the products that they sell in the market, they don't even manufacture. They just brand the product and they promote the brand. So they behave like an HUL or a Nestle or a P&G rather than behaving like a Sun Pharma or Dr. Reddy's when they are doing this business in India. And that is why this is a high growth, high ROE, highly cash generating business. And the valuations in this segment, ironically, are more reasonable than the valuations in the unbranded space. So therefore, we actually absolutely adore this segment for the secularity of the cash flow, for the valuation, for the margin of safety, and for the asset-light balance sheet that these companies have. So they're essentially recession-proof. And they have a lot of pricing power because we are in an environment where there is inflation and these guys have brands. So brands don't care about the cost pressures. They will just pass it on to consumers. So branded generics we are extremely bullish on. The healthcare index has about 22% weight in branded generics. The healthcare PMS that I run has 45% weight. So we are double the weight of the index in this bucket. The third bucket that we classify in healthcare is the API manufacturing, or in layman terms, the raw material for pharma manufacturing business. Now, this business has some historical context. Earlier, India used to be the dominant API player in the world back in 1980s. Then China came with no pollution control, and they became the leaders in the API space. Even India started buying from China. But now the cost for China has also gone up. Now, from a cost standpoint, China and India are more or less at parity as regards to most of the molecules. So many of Chinese customers who were earlier buying only from China are now buying from India as well. So here what has happened is it's a turnaround story where companies which are almost gone sick are now suddenly doing capacity expansion because their order book has suddenly blown up. And the reason the customers are migrating away from China are multiple. There is a geopolitical reason, there is a cost pressure reason, there is an inconsistent supply reason, there is an intellectual property challenge reason, there are multiple reasons. But the net effect is that those customers want to add one more vendor, which is not Chinese, to their product portfolio. And that is where India comes in. So China today sells $40 billion worth of APIs exports. India exports only $4 billion. So we are 1/10 the size. If China loses, 10-20% market share, the revenue for Indian companies can double or treble. So that is where you see, the opportunity for Indian API companies. So essentially, whatever has happened over the past 5 to 7 years in the Indian chemical universe is what we envisage will happen over the next 5 to 7 years in the Indian API universe. And the fun fact is that a majority of these stocks are still extremely reasonably valued, even compared to their own history and even compared to chemical stocks. So, it's a very interesting space. The weight of this space in the index is about 15-16%. In our portfolio is about 20-21%. So we are overweight this space. We like it. The fourth bucket is hospitals. Now, hospitals are essentially retail stores, but branded retail stores. So, in India, earlier hospitals were more fascinated by owning the land and building in which the hospital stood, which made the business very asset heavy. And therefore, ROEs were always low despite healthy margins. Over the last decade, majority of the hospitals that have come up from the organized players are actually asset light, where they lease the land and building and not own it, which reduces EBITDA margin because now you have to pay lease rentals, but that increases ROE because your asset base is very, very small. 70% of the capex of a hospital, if you own the land and building, is land and building. So if you're not owning the land and building, in 30% capex, you can open a new hospital, right? So now these hospital chains have started opening asset light hospitals, which has improved the ROE and margins. And therefore, we like the hospital business for that. It's a secular branded business, negative working capital, which should talk to you about the bargaining power of the business. So hospitals in the index is about 12-13% weight. In our portfolio, it's about 19-20% weight. So we like hospitals. Diagnostics, 85% of the diagnostic market is mom and pop stores, unregulated, unorganized market, and 15% of the market is organized retail chains like your Dr. Lal, SRL, Metropolis, etc. So we like the diagnostic business from a standpoint of unorganized to organized, something that we're seeing in many other subsectors in our economy. I think that is also happening in diagnostics. Yes, there are certain, new low pricing guys who have come into the market and they're trying to disrupt the market. But look, these are very, very early days. Even if there were to be a disruption, it will take 10-20 years, like it took Thyrocare, because Thyrocare was an original disruptor when they reduced thyroid prices. So it took Thyrocare 20 years to gain scale. So these new disruptors, although they've come to the market, they are trying their best. I don't foresee anything less than 10 to 20 years for them to, show any material disruption. So we have a lot of time for the incumbents still to gain footprint and grow and improve their ROEs. So which is why we like the diagnostic space still. Now, if you focus on what I'm trying to talk about, I'm trying to talk about diagnostics, hospitals, API manufacturing in India, and branded generics in India. It's all India, India, India. I'm saying we don't only need to invest in exports in the pharma segment or the healthcare segment. Our internal economy is very, very buoyant. Over the last 10 years, 2011 to 2021, India GDP CAGR was 5%. India healthcare market CAGR was 7.5%. Despite which today, while India's GDP per capita is $2,000, we are spending only 3.5% of that $2,000 on healthcare. Now, any other country in the world which has more than $2,000 per capita GDP doesn't spend anything less than 5% on healthcare. Which is, what does it mean? Over the next 10 years, if India's GDP were to grow at 8% CAGR, the Indian healthcare market would probably grow 12 to 14% CAGR, will grow higher than the GDP, which we have done already for the past decade, but we'll continue to do that over the next decade, because a decade back, we were 2.5% of GDP. Today, we are 3.5%. A decade later, we can be 4.5%, 5%, 6%. So, how much we achieve, we'll see, depends on a lot of things, including demography. But we feel that, a lot of these things will help the companies grow faster, because the market itself will grow faster. Just a data point on the US side. So in 1950, US used to spend 3% of GDP on healthcare, 28% of GDP on food and beverage, 10% of GDP on clothing. In 2010, those numbers are 13% on food and beverage, down from 28 to 13, 3% on clothing, down from 10 to 3, but 16% on healthcare, up from 3% to 16%. So what this tells you is, as the disposable income of an economy grows, the healthcare expenditure grows exponentially, and which is where our entire focus is on India, because we feel we are on the cusp of becoming a superpower. We are on the cusp of gaining more and more GDP. And when we do, the incremental expense is not going to go in clothing or food and beverage or QSRs. It will actually go into healthcare. Why invest now? So I hope I have sort of educated you on what we feel is the reason to invest in healthcare, but why now? So if you look at the 10-year history, we are trading almost at the 10-year average in terms of EV/EBITDA. But remember, EV/EBITDA has EBITDA as the denominator. So if the current profitability is in steady state, this ratio makes sense. But my point is, in the current scenario, the EBITDA of healthcare is actually suppressed, because we have seen cost inflation, but our prices have increased later. There's always a lag between the cost inflation and the price pass on. So the EBITDA that you currently notice in the healthcare segment is actually suppressed. So EV/EBITDA is not therefore a good indicator. The best indicator is price to book, because this is accumulated profits. The book value is accumulated profits, which has seen across cycles, low EBITDA, high EBITDA, stable EBITDA. So if you look at price to book, we are substantially below our 10-year average. If you look at return on equity, we are substantially below our 10-year average. So the best time to invest in any stock or any sector or any market is when the profit and the multiple both are below average. So eventually, when the business normalizes, the ROE will go back to average and hopefully go above the average. And then the multiples will also follow. They will go up at the average and then above the average, which is why, as an investor, it's a double bonanza for you. You get re-rating and you get earnings growth, you get ROE improvement. So which is why we are extremely optimistic about the portfolio over the next 5 to 10 years. This is the weight of healthcare in broader indices, again, below average compared to the last 10 years. Now, as I said in the beginning, healthcare itself is a diversified bucket. So our product, we don't call it a thematic, we call it a diversified healthcare product. So the diversified healthcare product, hospitals represent branded apparel retail companies, kind of a model, business model. The index has 12, the competing funds, the mutual funds that you have an option to invest in have 14%. We have 16% in hospitals. Diagnostics, 2%, we have 5%. Generics, 44, 46, we have 11. So substantially lower than the generics in the index or the mutual fund. API is 8% in the funds, 16% index, we have 20. And branded generics, the FMCG type business, the competing funds are at 22, index is at 21, we are at 45. So you can see our bend towards secularity, asset light, ROE, cash flow rich businesses. Now, if you had invested 100 rupees in Nifty 50 10 years back, today you would have 300 rupees, which is the blue line that you see here. Had you invested the same 100 rupees 10 years back into the healthcare index, you would have had about 400 rupees, which is the orange line here. But the healthcare index has that 45% unbranded business, which we don't really like. So we bifurcate the healthcare 400 rupees into two parts, into the unbranded businesses and everything else, which includes diagnostic, hospital, branded, generic, API, and all of that. So had you invested 100 rupees into only the unbranded businesses, over 10 years, it would have become 250 rupees. So less than the Nifty 50 returns. But had you invested 100 rupees in every other business, excluding unbranded generics within healthcare, your 100 rupees would have become more than 500 rupees. So 90% of our portfolio is on this curve, whereas only 40% of the index is on this curve, and only for 50% to 60% of our competitors' portfolio are on this curve. So you can see where we are, leaning. We are leaning towards a more secular wealth creator, towards a higher alpha creator, rather than staying with the bigger, more popular names, because we aren't looking for stability, or we aren't looking for low standard deviation of NAV for our investors. We are targeting higher returns over an invested period of time. So as you can see, today everybody's scared about inflation, and they wonder what inflation can have as an impact on your investments and equities. Let me inform you, over the last 20 years of capital history of the capital markets in India, healthcare has performed top quartile whenever inflation has been more than 5%. So whenever inflation is more than 7%, health is second best performer within all the several sectors that you can invest in. And whenever inflation is between 5 and 7, we are again top quartile performers. It's only when the inflation is in the sweet spot of 3 to 5%, that is when your cyclicals do better than healthcare. Healthcare, mind you, still gives you positive returns, but it underperforms other sectors. So in that regard, if you feel that coming 5 years, 10 years, we are going to see turbulence on the inflation side, you must have a healthcare exposure. You must, other than your diversified portfolio, because your diversified portfolio gives you only 3 or 4% healthcare. That is what the index in the broader index is. That is what the weight in the broader index is. So they will give you only 3-4% exposure. You must have a additional 10-15% exposure on healthcare if you feel inflation is going to remain high for the next few years. So I'll summarize and end with this. This is our portfolio returns over we have been just live since February 21, so we don't have very long-term data. It's only about a year and a half data. And it's a 20 stock portfolio, concentrated portfolio. Obviously, because most of the large companies are unbranded in nature, we have very less large caps. We have more small and mid caps, because all your API companies, your branded generic companies, your hospital diagnostics, they all fall within mid and small caps. And it's a 20 stock portfolio. These are the top 10 holdings that we have. And this has been the performance so far. So we are neck to neck with the index, but slightly better than the index after fees and taxes since inception. And yeah, so that's how the portfolio has evolved. So that's it from me. I thank you guys for listening patiently. Hope I didn't go too fast, and hope I was comprehensible. And if there are any questions or queries, just shout out.